So we know the Federal Reserve's next FOMC meeting is coming at the end of July, roughly about 2.5 weeks at the time of this recording. And we're going to use this, gentlemen, as a mid-year 2023 check-in on your credit, your finances. We're going to use this next FOMC meeting to give a gauge on what I see coming up, what I see if the Federal Reserve does continue to raise rates, and how it's affecting you. And I want to ask some questions that I want you guys to respond to so we can finish 2023 in a strong position financially and with our credit, or get on track if we're off track. So the Federal Reserve used the fact that they're going to be getting in some very important data reports the next couple of weeks leading up to the meeting in July, the end of July, to pause in June. The Federal Reserve did not get a lot of data before its June meeting, and it decided overwhelmingly that a pause was appropriate given the fact that they had raised so many times consecutively prior, and that they are feeling like, or at least the data that they're getting so far is indicating that they're going to have to continue to raise. So they're trying to decline or slow down the pace and the velocity that they've been raising at. That's the indication and the verbiage from Jerome Powell in the last FOMC meeting in forward guidance. So they're going to be getting a jobs report. They're going to be getting corporate earnings. They're going to be getting CPI and core inflation. And they're also going to be getting some consumer spending data in all before this next July meeting. And that's going to allow them to confidently come to the conclusion if they need to go up another 25 basis points. And they've also indicated that another couple hikes could be appropriate for the rest of the year. We need to address the fact that the sentiment the first quarter of the year was that the Federal Reserve was not going to be able to keep this up, and that we can expect a pivot as early in some cases by this time this year, right? So meaning that many analysts had it and the market had it that the Federal Reserve was going to pause by now and possibly even start pivoting. And that has been a huge shock to the market as well as analysts and us here on Main Street, gentlemen, where the Federal Reserve is not only not really taking their foot off the gas very much, but indicating that they could continue to raise throughout the rest of the year. We also have the banking crisis that has lost the media coverage, but still looming in the background. Are we still experiencing tightening or increasing tightening from institutions when it comes to lending? We need to discuss that as well. So if the Federal Reserve decides to continue to raise rates, if the July is what Jerome Powell kind of indicated to be a live meeting, and we get another 0.25% rate hike, then that is an indicator that the data that has come in is likely one of those 4 major data reports or more has come in hot, especially the job reports, maybe even corporate earnings. These are things that can be real major pushes towards the Federal Reserve saying, we got to keep going. Core inflation is another major one that they're going to be paying attention to. If core inflation is still not budging very much by their, perception of what it should be doing, then again, we could see another 0.25% hike. So what we've seen so far is any variable rates have largely gone up very significantly. Leading up to this meeting, mortgage rates are back at their peak at the moment. At the time of this recording, mortgage rates are a little over 7% at the 30-year mark, which is along the lines of the peak that we've seen the entire time since the rate hikes have kicked in, because the 10-year Treasury is picking up. The mortgage rates could continue to go up, which is a bit of a shocker as well compared to what we were, thinking and analysts were putting out earlier this year. So that's a whole conversation when it comes to residential real estate. We're going to have deposit rates likely start to go up a little bit more as well. So if you're a saver, then this could be a plus. If you have heavy cash access or you're sitting on a lot of cash reserves, if you're not invested very heavily, or if you are invested and still have a lot of cash, deposit products could continue to be more attractive. If you have any variable rate debt that's not fixed, then you could be experiencing more pressure when it comes to your credit and your finances in that department. If your debt load, again, is variable, or the bulk of it is in variable rate debt, the Federal Reserve continuing to increase could just put more pressure on you in that arena. Commercial real estate is obviously going to get a ton of pressure. Those of you who are working in job sectors that are interest rate sensitive. We shot a video about that in the past. The tech sector is just one example of an industry that is very sensitive to interest rates. If you are in the finance sector, if you are, anywhere near the investment sector, or investment banking, or if you are a mortgage lender, if you're a realtor, any of these industries that are extremely interest rate sensitive, what is that looking like for you going into the second half of 2023? So I see residential real estate is going to have a buying opportunity at these high rates. I've shot multiple videos that I believe very much so, due to the inventory shortage that we have, this is going to be a golden time to buy a primary residence, a very strategic primary residence, or rental property right now. In most cases, in most markets, real estate is very local. Generally speaking, these higher interest rates, these higher mortgage rates are going to at least stem the tide of housing prices. And in some cases, in some markets, going to create a little bit of a deficit as to where these home prices are going to start to come down just a bit, or at least create deals. And this is going to be a great opportunity to get in on good properties in great neighborhoods and high demand areas that can lead to the Federal Reserve dropping interest rates at some point in the next 12 to 24 months, and the inventory crisis not being reserved yet, and you being in property already that's already high demand, and more people with interest rates going down being able to afford it, meaning that you're going to see a massive spike in equity. Not that you necessarily may want to sell that soon, but to put you in a proper position in that home for the longer term. Again, we're millions of homes short in the residential market. That's not going to be an easy fix, and I think interest rates will adjust before we can fix that problem and create a great buying opportunity now in the next 6 to possibly 12 months, depending on how long rates stay high. What about getting access to capital? What I've personally observed is that depending on who you're going to for that capital, money is still flowing, credit is still flowing. What I have observed, and I've shot a video about as well, is that access to capital is getting pressured or hitting a fault line in the application process, especially if you are a business or a newer business. What I'm observing is that institutions that have the infrastructure, these larger institutions that have the infrastructure, commercial institutions, they are scrutinizing applications harder. They're looking for indiscrepancies. They're looking for any red flags. They're looking for any kind of indicators that may indicate you're a higher than normal risk than they're willing to take at the moment. So I'm not going to say that the money is not flowing for credit. What I am going to say is that applying for credit, particularly as a small business, a newer business, you may be running into more obstacles where applications are getting stuck, where you in normal places where you might get instant responses or really quick responses. So this is very important to understand that you need to have congruency when it comes to applying for credit. This is very important right now. We're going to shoot more videos around credit profiles, credit scores, and all of that aspect, around the current economic environment that we're in, because again, that's just shifting greatly from what it was a year or two ago. So a few questions for you guys. What industries are you working in? How is it affected by interest rates? What does your personal financial circumstances look like, gentlemen? What does it look like for you if you are running a family, running a household? How does it look like if you are single, but still out there, one day with the ambitions of developing a family or dating or whatever the case may be? These financial circumstances are touching every aspect of your finances in some form or fashion or not. You may be doing well financially. I want to understand more. We all want to know more about how things are working for you. What does this look like for you financially? If you're doing well, if you're in the industry or your income's great, it's growing, are you able to invest? What markets are you investing in? How is that turning out with interest rates being where they are and haven't been here in a long time? If you're being negatively affected, we have credit card debt through the roof. We have auto repossessions going up. Foreclosures are ticking up, even though it's not getting a lot of media coverage. So people are struggling, gentlemen. And some of you that are catching this content may be in that bucket. Talk to us. Where are you currently? What are you experiencing? What does the rest of 2023 look like for you? going into these higher interest rates that we're likely going to be seeing, and they're going to stay minimum through 2023. And also, if you're doing well, what's working for you? What industry are you in? And where are you investing? Or are you deposit heavy? Are you sitting on cash and sitting in some of these high rate deposit accounts, capturing this rare time where you can get CDs and high yield savings accounts that's technically above the official core inflation and official headline inflation rates? Where are you in that arena? I want you gentlemen to understand, do not allow yourself to lose track of your focus that you came into 2023 with. We're literally at the halfway point here in early July, and it's time to check in, gentlemen. It's time to start tapping in and finding out where we are now that we have our hats on straight and understand that the Federal Reserve is not pulling off the gas very much. Rate cuts are not coming anytime soon. We have to adjust our strategy around the Federal Reserve being serious at least through 2024 or up to 2024. We need to finish this year in a proper position, each one of us. And I want to have this conversation right now. So I want you guys to comment to some of those questions down below so we can keep the conversation going and talk about what this looks like leading up to this next FOMC meeting. And I'm going to be dropping subsequent content around some of the content as well as other subject matters that we're going to cover to try to help you either get out of trouble financially or to expand if you're growing right now financially. So comment down below. To all my pioneers, welcome back. To all my new viewers, welcome in. You want to learn more about the channel and more about how to support the channel, links in the description below. Other than that, I want y'all to stay focused, stay in motion. Gentlemen, I'll see y'all soon.
This is JP from Blueprint for Prosperity Network, a channel dedicated to helping you increase your net worth through relationship banking, maximizing your borrowing capacity, the proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity.